As we head into the 2022 planting season, grain producers have more factors to consider than ever before. High input costs, inflation, La Nina, and let's add in Russia's invasion of Ukraine and another supply chain disruption. And the result is perhaps the most dynamic market that farmers have ever had to evaluate when making spring decisions. So let's jump right into it. Scott Irwin, input costs, still a big story. Fertilizer prices have tripled from a year ago in some areas. How is that going to affect plantings as we look forward to the prospective planting report at the end of March?
No doubt that it's had an impact, particularly on decisions to plant corn versus soybeans. The corn is more subject to the increase in input costs, although they're also affecting soybeans as well. But right now it looks like that has probably tilted the playing field a bit in favor of soybeans. But I think it's important to keep in mind that both crops are still profitable unless you're buying in the spot fertilizer market right now.
We've seen a surge in the old crop bookings in the first 2 calendar months of this year. Demand was at record levels a year ago, but that can change. Look at the short-dated options. What are they telling us about how producers are approaching this planting season?
According to the USDA, between Russia and the Ukraine, they're expected to export roughly 34 million metric tons. So that's the same as Brazil or Argentina, and that's obviously very uncertain right now. What we are seeing is we're seeing a significant increase in the use of short-dated new crop options. At the end of February, open interest was over 100,000 contracts, well ahead of where it was this time last year. An average daily volume is twice that of what we saw last year.
All right, that's just on the demand side. We've also got to worry about the supply side, and that's where the weather comes in. Scott Irwin, La Nina brought drought back to southern Brazil. Soybean production there is expected to be lower. Could that pull more acres to soybeans here in the U.S.?
I think not only pull, but the market is now behaving like it has to pull more soybean acres. I think that's a reasonable way to look at it. Last fall, the market was signaling in the new crop corn and soybean futures that actually favored corn slightly. But as the South American drought has developed, particularly in southern Brazil and some other areas, soybean producing areas, you've seen that ratio of soybean and corn prices reverse and now beginning to more favor soybeans. So definitely looks like there's a lot of incentives for soybean production this year.
Let's talk about price volatility. Tim, the CME Group produces the CVOL Volatility Index, which measures volatility in some of the key ag products. What's the situation now going into the planting season?
Well, you wouldn't be surprised if I told you that over the last 10 days, CVOL for corn and soybeans has exploded higher. If you go back to February 23rd, CVOL for corn was 27%. For soybeans, it was 22%. In the next several days, that ran up to 38% for corn and 28% for soybeans. Now, it's really easy to look at those numbers and say, I think I missed the boat. Volatility has gone much higher. But keep in mind, last summer, corn peaked out at 57% and soybeans at 43%. So while it's much higher than it was at this time last year, it still has a lot of potential to get much higher. Going back to short-dated new crop options, this is actually the environment where these products shine relative to standard options.
Supplies out of the Black Sea, input costs, global weather patterns, export demand, they are all weighing on planting decisions this spring. That's even as we see the elevated prices for corn and soybeans. These stories are going to stick around and will continue to develop as we move into the growing season. How producers manage these risks will be a critical factor for the U.S. grain industry in 2022.